Earlier this month, one of the pillars of the Reserve Bank of India, Deputy Governor Harun Rashid Khan, HR Khan, retired after 38 long years of service. A large part of his years in Mumbai's Mint Street, where the Reserve Bank's head office stands, was spent regulating and building the bond markets. And this earned him the epithet King of Bond Street from the dealers. Besides bond markets, Khan, as Deputy Governor, was also in charge of the foreign exchange market, external investments and the payments system. Before he retired, Governor Rajan charged him with the task of finding some quick steps to energize and enlarge the corporate bond market. So what are those steps? Let's hear from the man himself. Well, Mr. Khan, thank you very much for dropping by in the CNBC TV 18 studio. Let me start where the governor ended his previous monetary policy press interaction. He said that repo in corporate bonds will be allowed, and Mr. Khan is going to be in charge of a committee that will present the roadmap to it. Can you tell us how soon we will be having repo in corporate bond markets?
Latha, let me just give a bit of a background about this corporate debt market, which you have been talking since ages. There are structural and plumbing issues which inhibit development of corporate debt market in India. And in fact, not many countries also have very robust corporate debt market, and many countries like India have a bank-dominated system. But the corporate debt market is assuming criticality because there is a risk diversification. It complements and supplements banks are doing, and more particularly in the Indian context, it also assumed importance because given the bank's position in terms of their NPL and other constraints, I think there is a need to develop corporate debt market. And particularly when we are also planning to see that corporates at an aggregate level, they should not get overexposed to the banking sector. Part of their financial requirement, they should go to the market and through the bond market. So if that is the case, then we need to do what all need to be done to develop corporate debt market.
Yeah, actually, it was in that context that I thought it was very crucial that RBI is actually contemplating allowing corporate debt in the repo transactions.
Yeah, that is the whole idea is that that would be a major change in terms of, we are only taking sovereign paper so far as the repo is concerned. But if you see world over there are central banks, whether it's unconventional monetary policy or quantitative easing and all, they have gone for a corporate debt paper and part of expanding their balance sheet. In RBI, we have been conservative, and rightly so, because given the illiquidity of corporate bond market and credit risk that may come on us, and it probably may have impact on the balance sheet. But we have to move on in the sense that if you want to develop corporate market, we have to do something which really will be a game changer.
I think I'm getting ahead of myself. Is that committee report which you were leading ready? Is it submitted?
I would just give a brief background. This was the FSDC has been discussing about this corporate debt market for quite some time. Then about a few months ago, the subcommittee of the FSDC decided that let us have a group of all regulators and government to give a list of implementable recommendations, not go for a big report, because there have been many reports on this corporate bond market, whether it is R.H. Patel report, Percy Mistry report, earlier Dr. Rajan's report on 100 small steps. So to call out what all can be done and what new things we can do for the corporate debt market. So we had all the regulators and government, we sat together and we worked out. Almost the job is almost done, and it is being submitted. Broadly, we had tried to look at what are the factors which can further enable development of corporate debt market, which I put it in a characteristic manner of, I would say, what you call 7I framework in terms of issuer, in terms of investor, in terms of infrastructure, in terms of intermediaries, in terms of instruments, and incentive and innovation.
Okay. Therefore, from what you are saying, it looks like a repo of corporate bond in RBI's LAF is only one part. You'll have many other recommendations.
Many other parts, and all the parts have to play together. And in fact, most of the regulators, and particularly RBI and SEBI, were mostly involved, and We have good understanding, and quite a few things, implementation timelines are also being suggested.
Okay.
So we'll see a lot of action next couple of months in terms of actual implementation. Okay. Not
so
just
which other areas? For example, the LAF is one. Yeah. What are the other things possible?
If I can take you through very quickly, for example, on the issuance side, we have not seen much of reissuances, and volumes are not there, so liquidity is not there. And the corporates have their problem because bunching will be there, they will have. So what we are trying to say that whether you can have same ISIN number but different redemption date, so you can do it. So NSDL, CSDL will probably work on that. And other thing is that if you do reissuances, whether the stamp duty can be removed so that there is an incentive for reissuances. Similarly, in the case of, for example, investor, we have now allowed foreign portfolio investors to invest. So now we have, as announced in the budget, now unlisted bond and PTC, they will be allowed to invest. Okay. And if you talk of intermediaries, the very, very critical point is market making. So what we are looking at is whether some of the brokers can be market makers, and if they become market makers, what sort of support they can get. So they probably will get an access to repo and corporate bond market, which is not allowed to them. So if they get an access through repo to the market repo, so probably they can make market making. And exchanges are working out a scheme, and I think it is in advanced stage of being implemented. And the other is in terms of banks and primary dealers are already trading members.
Yes.
So they could be also encouraged to become market makers. And if you see the infrastructure side, there are quite a few things. For example, one is electronic book electronic book for this private placement, and there is integrated trade repository where both primary and secondary market issuance is one place, prices, volume, everything is available. And one critical element of infrastructure is credit rating agencies, who play a very, very important role. So they will be encouraged to become members of credit information bureaus, so they can access information. They are eligible users, but many of them are not members, so they can. And also possibly going forward, whether they can be given access to the acrylic data, but that has to be used very carefully, because SMA 2, SMA 1, 2 doesn't mean that it is all full default. So probably that is one area. And the other critical part is some of the instruments we have introduced, they have not really taken up. Take the case of example of CDS. Repo in corporate bond. We try to, for example, in CDS we allowed few things, it has not worked. In the corporate debt repo we allowed reduce the haircut, allow CDCP, it has not worked.
So you will allow more partial reenactment?
So what we are trying to do is, in the terms of CDS, the main issue which has been stumbling block as per the market is this netting issue involving public sector, because of that capital charge increases. So we are in dialogue with government whether we can have the amendment to the RBI Act netting, and if that is not possible, pending that, whether based on legal opinion, because it's a contract, whether the netting can be allowed. So that will be a big boost. And so far as repo is concerned, we will like to have a screen-based platform. Some cases where they are liquid, it can be a CCP facility, and some where it is not liquid, it can be without CCP facility. So that is one area where we can work for this instrument. And other is, of course, tripartite repo for better collateral management. The other issue is very, very important from the point of view of incentive. You know, we came out with this partial credit enhancement. Yes. The whole debate over the years has been that corporate debt market has to stand on its own without support from the banks. You remember the Tata Sons case. But then we realized if you want corporates to move part of their requirements to bond market, at least in the initial stage or the nascent stage, some bank support will be needed. That is why this partial credit enhancement by way of a compromise sort of thing was brought. But that has not taken up. So one of the thinking of the group is that whether that 20% limit can be increased, but without making each individual bank overexposed, so whether that can
this credit enhancement is at capped at 20%.
So it can be increased, maybe 30, 40, 50%. And also NBFCs who are providing credit enhancement, for them there may not be any limit.
But what is the timetable for all this? This is
another very critical point in terms of incentive, as I started, is that corporates' exposure to the banking system as a whole should come down, and part of that they should go to market. So that is a work in process, and RBI will come out with their own recommendation. And of course, finally, as you mentioned, is this making LAF eligibility. The whole idea is that once the market report, tripartite MIPO gets some traction, there is some liquidity, probably we can open up this for LAF. But we have to see the legal aspect, because RBI Act is not very, very clear in terms of whether we can accept or not accept. That will be examined. My hunch is that pending RBI Act amendment, possibly we can do. And very, very important thing which has happened is this bankruptcy code, which is one of the main stumbling block. We have now the bankruptcy code in place, but the challenge lies in creating that infrastructure of courts and insolvency
NCLT tribunals.
Professionals. I think that is something that we're going to.
Oh yes, that certainly is something which the whole nation is looking forward to. But I just wanted the most attractive proposal. I mean, one of the more attractive proposals is allowing corporate bonds to be used in the LAF window. What the legal opinion at that time was that RBI would only take sovereign paper. Is this settled, or
no? I would say it is not settled, but I think we will be in a position to interpret that it can be taken. Of course, there has to be very sound risk management practices in terms of rating, in terms of haircuts and all that. But if there are ambiguities, better to get the act amended. So that view has to be taken.
Okay, now I wanted to know the timetable. When can we?
I believe many of the things should happen over the next 2 months.
Okay, so in the current governor's tenure itself, some of it may be implemented?
I suppose so. Some of the things will happen. For example, allowing FPIs to invest in unlisted debt and PTC can happen anytime.
Okay.
And a few things, market making, all that SEBI is in advanced stage of doing it. And we are also in dialogue with PFRD and insurance companies. They will also slightly relax their norms for investment. And for example, 81 bonds of banks, so insurance companies and PF funds, they will probably be investing. So we are in dialogue with them. So some of the major recommendations are likely to be implemented sooner than what was expected, because the whole idea of this group is to give the recommendation and lay down some time frame.
Yes.
So that is what.
Okay, we need to take a break, Mr. Khan, but I have a couple of more questions, both on the development of the bond market and of course the tricky issue of the FCNRB money that will be pulled out end September and early October. We are back in a minute.